Welcome back to Investing Talk Podcast.
Today we're looking at SoFi.
As usual, before we start, subscribe, like, and comment to this video to support the show. It really helps us out with the algorithm. Now, let's get into it.
Okay, so we have to start with the news that dropped yesterday, January 30th.
The Q4 earnings.
Exactly. SoFi released their Q4 2025 earnings, and honestly, the whole narrative it's fundamentally shifted.
Oh, so.
Well, for the longest time, this was a show-me story. It was that student loan app trying to prove it was a real bank.
Right. The question was always, can you actually make money, or are you just burning cash?
Precisely. Is this just a burn rate machine? But looking at these numbers, they're not just trying anymore. They've hit record numbers. The era of burning cash, I think, is over.
Okay, let's unpack that, because the headline numbers, they look great. I've seen the glossy press release, but I have to play the realist here. You say the narrative's shifted, but look at the stock. SoFi rallied hard in 2025, up what, 70%?
Huge run.
It was pricing in perfection. But year to date, in 2026, it's actually down about 7%. So the market's reaction is, let's say, cautious.
That's fair.
It feels like the market's looking at that recent $1.6 billion capital raise and asking, is this a war chest? Or a warning sign?
And that is the billion-dollar question. That's the tension right now. But I think this quarter really is that pivotal moment, the moment they go from cash burner to a sustainably profitable bank.
All right, let's pivot to the hard numbers then.
Yeah.
You're saying the engine is running hot, prove it. What did they actually report for Q4?
Fair point. But this was a clean beat. No asterisks. Adjusted net revenue hit $1.013 billion.
Brink the billion mark.
Smashed it. And that's up 37% year over year. The consensus on the Street was looking for, maybe $895 million? They cleared it comfortably.
I'll give you that. Breaking $1 billion in a quarter is a big psychological win. And the bottom line seems to back it up. I'm seeing GAAP at revenue at $1 billion. But the number that really jumps out at me is the adjusted EBITDA. $318 million. That's up 60% year over year.
You were absolutely right to focus on that. That 60% jump is the headline for me.
And strictly on earnings per share, they posted 13 cents, beating the 12-cent estimate. So real money. This isn't some adjusted profitability.
Exactly. And that EBITDA number is so important because it's a proxy for raw cash flow. Seeing that jump 60% while revenue only grew 37% tells you one thing.
Operating leverage.
Operating leverage. As they get bigger, they're getting much, much more profitable. Their costs are becoming more fixed, but revenue is just scaling.
Right.
And it's not just about Q4. It's their guidance for 2026. They're projecting revenue of roughly $4.6 billion and an EPS of around 60 cents.
Which implies they expect to keep growing revenue at, what, a 30% clip?
That's the plan. I mean, think about that. A traditional bank would be popping champagne for 5 or 6% growth. SoFi is growing like a tech company, but printing money like a bank.
Okay, but we need to look at where that money is coming from. Because SoFi isn't just one business. It's a three-legged stool, right?
Lending, financial services, and the tech platform.
And looking at the report, I'm seeing some serious divergence there. It's not all sunshine.
You're spotting the big shift in the business, and this is the most exciting part for me. The growth isn't coming from where it used to.
Not from student loans.
Not anymore. The financial services segment, that's your checking, savings, credit cards, investing, that revenue grew 78% year over year, over $450 million.
78%. That is a huge jump.
It is, and it proves that their productivity loop is actually working.
Let's pause on that buzzword. The financial services productivity loop. What does that actually mean for a customer?
Think of it like a flywheel. SoFi spends money to get you to open a high-yield savings account. You deposit your paycheck. That's cheap money for them. Then they take your deposits and lend them out as personal loans to other members. Because they aren't borrowing from Wall Street, their profit margin goes way up.
They cut out the middleman.
Exactly. And then you get a notification. Hey, you're pre-approved for a SoFi credit card, or start investing with SoFi. Every new product you use makes the whole system more profitable.
So they're becoming their own supply chain, bring in the cash via deposits, sell the product via loans. Makes sense.
It's a massive structural advantage.
However, and here's where it gets interesting, the other side of the coin. While financial services boomed, the technology platform, Galileo and Technisys.
Yeah, that was the sore spot.
A sore spot. Their accounts dropped 23% year over year. They lost a major client. This was supposed to be the AWS of fintech. But if accounts are dropping by a quarter, that narrative is taking on water. The bank is flying, but the tech side seems to be dragging.
That's a fair criticism. The client loss hurt the diversification argument for sure. But look at the bigger picture. That 78% growth in financial services is more than making up for it in dollar terms. And they're widening the moat on the consumer side.
The moat being making it a pain to leave once you've signed up.
Exactly. High switching costs. If your checking, savings, credit card, and investments are all in one app, you're not going to leave for 0.1% somewhere else. It's sticky.
And they're adding things like the SoFi smart card, that SoFi USD stablecoin.
And the Templum partnership, giving you access to private equity like Epic Games.
It's ambitious, the one-stop shop, but it's also becoming incredibly complex. And speaking of managing all this, that capital raise, $1.6 billion at $27.50 a share.
That spooks some people, yeah.
To me, it just looks like dilution. They issued over 50 million shares in December. My slice of the pie just got smaller. Why do they need that money if they're so profitable now?
I see it as ammunition, not desperation. They don't need the cash to keep the lights on. They raised it to fund growth, maybe for M&A. It gives them options. Even BofA called it a modest positive because it extends their runway.
Modest positive is a polite way of saying, we hope they spend it wisely. But I get it. Raise money when you can, not when you have to. All right, let's see how the market is pricing all this in. Pivot to the charts.
Let's do it.
The price context here is volatile. In 2025, the stock rallied 70%. A darling. But the start of 2026 has been rough, down about 7%. We're sitting in a range of roughly $24 to $27.
It is consolidating for sure, but there are clear levels to watch. That mid-$20 range, say 25 to 26, has been a reliable buy zone.
The floor.
It's been acting as a floor. But if it breaks, Bank of America has a downside target of 2050.
Oof. Come 50 would be a painful drop from here.
It would. But on the flip side, Goldman sees $24 as the floor. So we're trading right on top of that Goldman support level. It's a battleground.
It looks like a classic mid-channel oscillation. It's in a long-term uptrend, technically, but just chopping sideways. Needs a catalyst.
And we might have seen a setup for that right before earnings. There was some really interesting options activity, a lot of positive gamma flow.
Okay, break that down for people who don't stare at option chains all day. Positive gamma flow. Why does that matter?
Sure. So when a ton of people buy call options, betting the stock goes up, the market makers who sold them have to hedge. They do that by buying the actual stock.
Right.
As the stock rises, they have to buy more stock to stay hedged. It creates a feedback loop that can push the price up faster. The market was positioned for a move, and here's the kicker. The bears are crowded.
High short interest.
Very high. A lot of people are betting against it. If that $24 support holds and the good news sinks in, you could see a squeeze.
Okay, so a real standoff. Let's transition to checking the market mood. What are the big players actually doing?
Sentiment is what I'd call moderately bullish, but definitely mixed. It's not euphoria.
That feels right. When we look at the quantitative scores, the new go-to partnership scored really well. But at the same time, we're seeing analyst notes pop up about overvaluation.
It's a tug of war, but look at the institutional moves. Big money is moving in. Diversified Trust Co. increased their holdings by almost 197%.
Wow, that's a conviction bet.
And Cathie Wood's portfolio is showing interest again. These are growth funds doubling down.
That's the risk-on money. But Wall Street analysts are split. Goldman is neutral, $24 target, basically saying it's fairly priced.
Right.
But Bank of America is underperformed, 2050 target. They're worried all the growth is already priced in.
That's the traditional view. But you have to counter that with the long view. I mean, independent analysis, like from 247 Walson, is projecting a target of around $55 by 2030.
55 by 2030, that's more than a double from here.
It is. The argument is that the bank charter gives them so much leverage. As they cross-sell, the profit per user just explodes.
55 is a nice dream, but what are insiders doing now? They sold about $4.4 million worth of stock recently. It looks orderly, not a panic dump, but still.
It's worth noting, but I always remind people, that's just standard housekeeping in high-growth tech. They get paid in stock, they sell to cover taxes. I don't see that as a red flag.
Fair enough.
Yeah.
But there are red flags we need to discuss. Let's transition to where could this go wrong?
Absolutely. We have to look at the bear case.
The elephant in the room has to be valuation. The stock trades at about 53 times trailing earnings.
That is a premium.
Premium is a nice way of putting it. That's nosebleed territory. JP Morgan trades at what? 12 times earnings. You're priced like a high-growth software company, not a bank. You have to be perfect.
That is the risk. You get the higher multiple for the growth, but you also get the volatility. If growth slows from 30% to, say, 15%, that multiple collapses.
And then there's the dilution we touched on.
Right.
Risk number 2, they have to deploy that $1.6 billion efficiently. If they waste it, it destroys value.
And risk number 3 for me is the crypto and tech reliance. The tech platform accounts dropped 23%. That's a drag. And launching SoFi USD ties them closer to crypto.
A double-edged sword.
Exactly. It invites regulatory scrutiny, high reward, but high risk.
And finally, risk 4, macro. At the end of the day, they're a lender. If unemployment ticks up in 2026 or the economy slows, their loan book could see higher delinquencies.
That is true, although their borrower profile is very high quality, average FICO of 750 plus. So they're insulated but not immune.
Okay, we've looked at the record earnings, the shaky chart, the divided analysts, and the expensive valuation. Time for the final verdict.
I've weighed the risks and the rewards here.
What's the score?
I'm giving SoFi a bullish score of 8 out of 10.
An 8 out of 10, that's confident. Walk us through the thesis.
Look, SoFi has successfully graduated. They went from cash burner to earnings compounder. The 37% revenue growth and 60% EBITDA jump proved the model works.
And the bank charter.
The bank charter advantage is permanent. It lowers their funding costs. They're building a moat that gets wider every single quarter. The losses in the tech platform are annoying, but the core engine, the bank, is just firing on all cylinders.
So you think the profitability is here to stay?
I do. And the target horizon here is a core position for 3 to 5 years. This dip to $24. I view that as a buying opportunity for the patient investor. You're buying a future banking giant at a reasonable entry point relative to its growth.
I agree on the profitability pivot. That's undeniable. But I'm going to add a word of caution to your 8 out of 10. Watch that $24 support level closely. The valuation at 53 times earnings leaves absolutely no room for error.
True.
But if you believe in the long-term vision that the future of banking is a single app that does everything, the numbers are finally backing it up.
It's definitely one to watch.
If you enjoyed this breakdown, make sure to subscribe, like, and comment below. We'll see you in the next one.